You're listening to the Ottawa Real Estate Podcast, brought to you by Referral Mortgages and Blue Panda Realty, with your hosts, Paul Stevenson, David Warren, and Greg Campbell. Let's see what's going on in the world of real estate in our nation's capital.
Greetings. Greetings. This is the Ottawa Real Estate Podcast. Every week, we get together here to talk about mortgages, real estate, whatever else we want to talk about. I'm Paul Stevenson. I am one of the owners of Referral Mortgages here in Ottawa. I'm also a mortgage agent, and I'm joined as always by Greg Campbell, who is a partner over at Blue Panda in Orleans, and David Warren, who is my business partner here at Referral Mortgages and also a mortgage agent. And you can watch or listen to the podcast on YouTube and on the podcast service of your choice, where it posts every Tuesday, 10 a.m. And if you're interested, you can also listen to the show live Friday mornings, 10 a.m. here on our Facebook page. And we'd also like to just give a quick shout out to our sponsor, North Brew Coffee. North Brew is a locally owned and operated coffee company, and you can use the code podcast when you check out at northbrew.ca, and you get 20% off all of your coffee orders. Gentlemen, how's the week going? How are we doing?
Great. We're doing great. Paul, I love that little intro. It looked like you were reading something. Were you reading from script?
Yeah. Well, as we've seen over the last, my camera is just flip-flopping here. As we've seen over the last month, my intros are pretty sporadic. So I figured, let me write it down. Let me make it official.
Good. Write it down. You write it down. You just, you practice it 10 times and you just become second nature. That's it.
Yeah. My lean, I definitely had a serious lean though. I mean, you're going to get you might get blinded by the light.
We were seeing the
scalp,
dome, in the dome piece.
Yeah.
I have some news. I have some news about our sponsor. I was actually over at North Brew yesterday at the new headquarters. It's Canatech.
Oh, sweet. That's where we started.
Yeah. I know. And anyway, so the reason we didn't get the shirts is because their press broke down, malfunctioned. They were waiting for a part, and it's very difficult to get. So anyways, yesterday, James was kind enough to give me the t-shirts and the what are they called? Like the design. I know there's a term for them, and I'm going to take them to Printwell, and I'm going to get it done. It's not silk screen. It's for the heat press. They use a heat press, but it's whatever. Anyways, so I've got all we had was dark blue. So I've got 4 dark blue shirts, guys. And I have two of one style of logo and 2 of the other style. So I'll just, I'm going to get them done and then I'll deliver them to you. And you can
fantastic.
I decided this morning too, while I was getting ready, that I need a tow rep hat. So I'm just going to go get one. Start wearing it around.
Tow rep hats.
Yeah.
Got to get some nice hats.
Yeah. For the sun. To protect my scalp. How was the week going? I know things have bounced out. Greg, you were giving us some stats before we came online here about Orleans and some of the prices kind of bouncing out as we kind of expected. But maybe you want to share that just so everyone knows where the numbers sit.
Yeah, it's a pretty. I was pleasantly surprised, to be honest. The average of residential sales residential sales across the board, like any type of home. I just kept it vague to get a general idea, but the average list price was $660,000 and the average sale price was $665,000. So I thought that was something nice. There wasn't a big, there's still some homes that are selling higher, but on average, there's only a $5,000 difference. So that's definitely a good sign that things are cooling down a bit. However, of course, I was in on multiples the other day, and we lost by 50, I think, yesterday, and the day before we lost by 110.
Oh wow, that
was in Sandy Hill. But anyways, that one had 7 offers. That was an exceptional property. It was priced, I think it was priced competitively. So, I mean, it's still happening. But then we're seeing homes, conditional sales. I was involved in a conditional sale. And it's just, it's balancing out a bit now, it seems.
Conditions, you say?
Conditions, yeah. Financing conditions, which I think are a positive. And even for my sellers, if someone's coming in with a financing condition on it now, I'm kind of saying, like, you know what, for your property and for the way the market's moving, it might be a good idea to have the financing condition in. What do you guys think about that?
It's always good to have, if it's possible at any point, will never tell you to leave a financing condition out. It's if one can be include it. It protects you, the buyer, it protects the seller, especially if there's something wonky in your file. If if it's new to Canada or a stated income, it's not just a straightforward income structure. It's always good to have it in if possible. Obviously, there's those instances where it's multiple offers, like you said, and it's tough to put it in. But in that case, just doing the due diligence ahead of time, providing the person that you're working with, the mortgage professional you're working with that listing ahead of time before putting the offer, so they know and can see what that, do all the numbers, make sure that everything looks good. But right now, and I know we were talking, kind of messaging about it the other day, is that it is really tough right now with the banks as well. So for any of you realtors out there or clients that it's not only it's not your mortgage broker or bank professional that's sitting on their hands on a file. It's that they're in some cases they're taking 3-4 weeks to get approvals, sometimes longer depending on the bank. I submitted one for a purchase June 9th and just got the approval back this morning. And that was with a major bank, goes by a big green logo. And so, just to give an idea of how long it could possibly take. And that was a purchase. Luckily it's a new build, not closing for a little while. So it definitely got bumped down in the queue, but it's something to be cognizant of for all those realtors out there, setting quick closings, like anything under 4 weeks is extremely tough. There's some lenders that'll be quicker on turnarounds, but certainly by and large, set those closing dates 4 weeks plus out, because it's not just the getting an approval back, but appraisals as well. Appraisers, there's just not enough of them. I think we've talked about this before. Basically, most all purchases, refinances all require an appraisal, but also most purchases do as well. And there's not enough appraisers. It's not an industry where there's a lineup of people joining the industry to help, lighten the load for the ones existing that have the experience. So, it can take 2, 3, 4 weeks to just to get an appraisal back. So, there's that component as well, which adds to it. So just for any realtors out there, any buyers, certainly be cognizant of that when going in with offers.
Yeah. And I think it's about time it changes because, there's a lot of buyer fatigue. I mean, I'm seeing it 100%. There's buyer fatigue and then there's still sellers coming in. I heard of one the other day where it was listed in the high. Well, it was listed. Yeah, no one's listening. It was listed at 800. I'll just give the exact number. It was listed at 800 and they got an offer close to $1 million and they turned it down and they took it off the market because they were expecting over $1 million. So there's that going on too. So, I mean, I think there's agent fatigue as well. But the conditions would be like I've said before, it's a happy return to some type of normalcy and just more. What's the word I'm looking for, guys? What's the word I'm looking for? Stability in offers and agreements. Yeah, I like that.
Yeah, agreed. It makes things a lot less stressful for everyone involved.
Yeah, including the home buyers. I always say this in my emails to clients, but when I'm introducing them to you, Greg, I say this process of working with the two of us will make things smooth and less or more seamless. You know what I mean? Like if you're trying to buckshot or learn from a friend or do something on your own, it can certainly create some hiccups. And even as we just said, even when dealing with professionals, there's still delays that are out of our control. And there's things that just happen that you have to be prepared and be properly educated, as we keep alluding to. One thing we have been seeing on our side a lot is we've been seeing a lot of refinances this year. where people are, existing homeowners that are looking to access some of that equity and invest into other properties. And Greg, I know we've connected on a few of those where we've had clients from a few years ago that, they've seen their value go up pretty substantially over the last few years, and interest rates are low. So it made sense for them to kind of refinance or restructure their mortgage and pull out some of that equity. And Dave, maybe if you can, do you want to just tell the listeners kind of what exactly is a refinance and some of the reasons that people might do that and some of the advantages?
Yeah, for sure. So, I mean, as you alluded to, we've certainly been seeing, and I think all the banks have been seeing record numbers of appraisals across the country, and why also this backlog with the lenders. With home values going up, especially in Ottawa, we keep talking about the percentage gains or month over month or year over year. A lot of homeowners that have a property, their primary residence, they've had it for a few years, typically under, even only 2 years, 1 year, 3 years, the home value's gone up. And so certainly a strategy for acquiring rental properties, if that's a goal of yours, that it's not saving up. You do need a minimum of 20% down to purchase a rental property. But, most investors are not going out working and saving that 20%, buying one property, going out, saving up 20%, buying another property. They're leveraging their existing portfolio or leveraging their primary residence. So, value's gone up. You can refinance up to 80% of the appraised value of the home. So whatever your current mortgage is, and up to 80% of the appraised value, that you can pull out that difference or that delta in equity, and use this to purchase, another property. So it's a great way of, leveraging and speeding up your path to, to home ownership and or building your rental property portfolio, if that's a goal of yours. And certainly one that this past 2 year, couple of years, especially, that I've seen a huge ramp up of people doing this, just with home values jumping so quickly, where even they bought it a year ago, they maybe bought a townhome in Stittsville or a townhome in Orleans. We talked about home values in January being up $100,000 over last year. So, that increase of $100,000 from 2020 to 2021, that equates to $80,000 that you could pull out of your home to purchase a rental property. And really, just from the numbers, that's getting you a place at $400,000. So it's a great way of kind of expediting that and doing the same, acquiring that rental property and then, maybe getting rents up or even as is, and, letting it go another year, 2 years, go up in value. And if, we're hoping for some stability, as Greg said, in pricing, but, if it does continue a little bit of this trajectory, maybe you're able to access some equity in a couple of years or 5 years to pull out that equity and leverage again. Whenever refinancing, it's tax-free money. So it's not money you claim as income either. So it is certainly, a great way to build that portfolio, because saving up that down payment's after tax dollars and is more costly. So it's certainly something that we've been seeing and seeing, very, very regularly.
Yeah, I had a very unique situation yesterday where I had two clients that were currently own a home in Canada. Value was roughly $700,000. They were being offered one of their parents' home to basically assume it, because the parents were buying a condo, and they were debating whether or not they should convert their property, their current property, to a rental or sell it, because the property has literally doubled in value. They bought it at $350,000. It's now worth $700,000, and in 4 years. And wow. And their parents' place is also worth $700,000, so they could literally just port the mortgage from one property to another if they moved, or they could do what Dave said, kind of pull some of the equity out of that first home and then basically take over their parents. But then it runs into this is what made me think of it, Dave, because of the capital gains, is if they now convert that property to a rental, then when they do sell it, it's now an investment, right? So they're going to be paying some capital gains on that. Whereas if they sell it currently as their primary home, they can take all that, that sale, all the equity in the home, basically the sale proceeds, without having to worry about that tax. So they're kind of just, mulling over all the options. But I mean, we've seen a lot of that in Ottawa recently with home values just skyrocketing. And some of the other reasons that people refinance too are, consolidating debt. So if people have, if you've been without work or what have you in the last little while, I mean, there are ways that you can kind of restructure your mortgage to access some of that equity to pay off some debt or consolidate it. Investing both in real estate, but also, in the market as things kind of climb back, there's a lot of sound investments you can make. And then one of the other things is just basically getting a better interest rate. So interest rate savings. So, there's a lot of people that are still kind of in that, high 2, low 3 range. And there are certain circumstances where it makes sense to actually pay the penalty with your current lender to restructure the mortgage and then, lock in at the kind of 1.5% to 2% range that we're in now, which, if you still have 2 or 3 years left, you can very likely make that penalty back just in interest and payment savings over the coming 2 to 3 years. So there's lots of reasons why people do this, but we're definitely seeing it more frequently. And I apologize, Greg, for cutting you off there. I think you were going to respond to something Dave said, and then I just went on a bit of a tangent.
No. That's good. And now I have something I want to ask you, Paul.
Yeah, shoot.
So when someone's, consolidating debt and refinancing, like they have to be approved to qualify for the refinance though, right?
Not with us. No. Okay, yeah, they do. Yeah, we just give money away. No, they do. So it's very similar to as if they were buying a home. Like the
Right.
the debt ratios and so on need to be in line. But oftentimes, incomes increase over time. Debts usually decrease, and a lot of the time when they're qualifying, like if we look at just their income and their current debts, if they have say $40,000 in consumer debts or car loans or things like that, that really kind of skyrockets their, what we call debt ratio. So the percentage of their actual annual income that's being used for the mortgage and all of their debts.
Right.
So by consolidating it into the mortgage at a much lower interest rate, the payments are decreased, which then kind of allows them to, it saves them on interest, obviously, but it also lowers their payment on a monthly basis. So their percentage of their income that's being used for their debts actually lowers pretty substantially, because instead of $5,000 a month they need to commit to their debts, it now adds maybe an extra $300 or $400 to their mortgage payment because it's amortized over 25 years
Right.
instead of maybe 5. So it lowers their monthly obligation, which then allows them to have a bit more cash on a monthly basis and get them in a better financial position.
But so another question to that. So let's say for the last year, someone's been on CERB and they have $100,000 in equity in their house and they want to pull out $25,000. Is that even like, will someone do that for them?
So
Or they need proof that they will have a job at some point?
So it's a yes and a no. So with a traditional bank, no, they need to have stable income, and they could have been on CERB and out of work, but now back to like guaranteed hours because things have opened up, and they can get a letter of employment that states they have guaranteed hours and provide a regular pay stub. And maybe they were out of work the last 12 months, but have started back, as of today, because maybe their industry just opened up today, and that would be fine. But if you're currently still on CERB, then no, they need that regular conventional bank or what's called or an A bank. They require that income. For alternative lenders, so alternative lenders, you got one silo of your traditional A banks, and then you have alternative lenders, which you got B like banks or B banks, and there are some programs that will lend based on the equity in the home. So we'll still allow you to refinance, up to 75% of the value of the home with based on just the equity. Now your interest rate is substantially higher. Yeah. It's obviously premiumed because there's no proof of income and things like that. So there's a higher risk of default associated. But if that's something that somebody needs because maybe they have been on CERB and they need to pay off some debt and really kind of eating that higher payment rate or higher rate is maybe still worthwhile because they're paying off, a car loan that's killing them at $800 a month or something like that. And maybe it makes sense from a cash flow standpoint. But So it's a yes and no. Yes and no question.
But there's options. I mean, there's options for everybody, obviously.
Yeah,
it just depends on what you're looking at. Yeah.
Yeah, absolutely.
We're like Baskin Robbins, we got a lot of flavors over here.
And I was going to say something to what Paul was mentioning too about the debt consolidation and things like that. So, for a lot of people, they might have bought a home where they bought it at 10% down or under 20% down, and the maximum they can qualify at is a 25-year amortization. So an amortization is the length of time to pay off the mortgage, and anything under 20%, the longest you can go is 25 years. Now, on a refinance or a conventional mortgage, you can go as long as a 30-year amortization. So let's say somebody only qualified based on 20% down or 10% down rather for $400,000. And they say, well, we've got some equity, but we didn't, that was our max qualifying. Well, we can likely qualify you for a higher amount on that refinance because we're going to 80%. It's a conventional mortgage where we're able to stretch that amortization, which, really allows for the payments or to kind of eat up some of that equity just by playing with that amortization. So, maybe, like I said, maybe you bought a home a year ago or 2 years ago and you were at your max, but by refinancing, we can play with the numbers a little bit by playing with that amortization, which lowers your monthly payment and allows us to increase that loan amount. So there are some ways in which you can play with it.
Cool. Yeah, I just that actually just happened with another one of my clients. We were basically refinancing. She wanted to access a little bit of equity to do some renovations, but we were able to actually consolidate car loan and a few other pieces of current debt to consolidate it all together, and actually did it over 30 years instead of the 25 to make sure that the numbers all worked. But again, it's probably going to save her close to $1,500 a month in credit obligations, payments. So that's cash in her pocket now that she can either rapidly pay down the mortgage. Like we qualified her on the 30-year amortization, but most lenders will actually allow you to increase your mortgage payments by up to 20%. So, for payments $2,000, she can increase that to $2,400, and then extra $400 every month goes directly to the principal. So, she can cut that amortization back to 25 by just increasing her payments, proactively, so there's lots of flexibility. Most lenders are pretty good about that. They kind of understand the full financial picture, and they're certainly not trying to pin you to the ground and make you default. They want you to be able to make your payments. That's their business. So most of our lenders are pretty understanding of that. And to your point, Greg, earlier about turn times and stuff like that, our relationships are very strong with both clients, but also lenders, and lenders are they know that when we send them a file that we've done our due diligence and we understand what the client's goals are and so on, and we give them a very clear picture. And that does help with turn times because, they know that they're getting a fully underwritten kind of reviewed file with clear notes, as opposed to, some brokers and banks will send in applications that just say, looking to buy a home, 5% down, please approve. It's like, well, what do you want me to do with this? So you got to be thorough in your notes, and those relationships obviously go a long way. But yeah, refinancing is definitely something that, I think in the past, doing a refi or getting a second to invest in another property was definitely our parents would be, oh, don't be getting a second mortgage. You're basically at bankruptcy when you do that. But there are ways that you can leverage the equity that you do have, and the home ownership, once you're in the home, there's lots of creative ways that you can structure things and kind of benefit from that equity that you've built up through your payments.
And in some cases, if you have a rental property already in your portfolio, when you're refinancing that rental property, you're increasing the loan, which the interest on that loan is tax deductible as well. So you're not only getting tax-free, the refinance, the proceeds from that refinance are tax-free, but you're also have the tax advantage of that interest write down. And let's say, you were debating whether to refinance or sell. Well, if you go and sell, really the difference because there's going to be 20% equity remaining in the property because you can only refinance up to 80%. Well, something to consider is the true cost of selling the home as well. So paying fees, paying legal fees, all of that, there might only be a difference of actual equity of 15%. So you might be better off leveraging that property, refinancing, taking that to either do something else with, maybe pay down your personal mortgage or invest in the market or buy another rental property. But there's also, I know we've talked a lot, and there's obviously a lot of new builds going on in the city. People's signed purchase agreements 2 years ago. It's not uncommon. In some cases, even longer than that. And value of that home on that new build has gone up by the time you close on it, the banks will only finance the higher of the purchase price. The lower of the purchase price or the appraised value. So if you're purchasing a new build for $600,000, the appraisal is at $700,000 because you signed it a couple of years ago. The bank will only finance at $600,000 on closing. However, there are some banks that will allow you to refinance, basically right after closing. So you could close on it, maybe set it into a variable rate mortgage, something like that, where your penalties minimized, and go and refinance it right away to pull that equity out, to leverage that pretty well immediately. So, these are just conversations to have with the person you're working with, so that, they can ensure that the mortgage you're getting into, you're minimizing the penalty, or kind of that penalty risk mitigation, if you will, and as well structuring it properly to kind of make sure that it's aligned with your goals too. And sometimes it's not all about rate. If you're wanting to, get it, refinance it right away, well, have that conversation, because, getting into a fixed mortgage because of the rate might not be adequate, because the penalty is going to be substantial. So you want to, kind of look into that as well, and set those goals and have those conversations. Those aren't things that you need to, hide from your mortgage professional. Like if you're thinking of refinancing that home or that new build, or selling it off quickly or something of that nature, have these conversations up front so that you can plan accordingly and minimize your costs down the road. But
sorry, I was just going to say, just because we're talking about new builds, I just wanted to interject quickly. Yeah. I've noticed that builders are now, they're cooperating more. There's some builders now that are cooperating with realtors how they used to, as opposed to, the lottery system and the auction style. So I guess for some builders in some areas, things are kind of stabilizing a bit. I'm going to use that word again, stabilizing, where I'm getting emails saying like, we're cooperating at this percentage. These are our incentive packages. Bring your buyers. I'm like, oh, okay, sweet. So just for those of you out there who, as we've said, a lot of people are getting lost. Like, I want to get a new build. And I'm just like, no, it's impossible. You can't do it. Now I'm seeing some type of light where it's a little bit easier to navigate.
And are those builders the same ones that were shunning realtors 6 months ago?
No, these builders never really shunned. I wouldn't say. It wasn't the ones that we spoke of earlier. A couple I had some good relationships with, but I know I'm not the only one getting these emails. Mm-hmm. But it was just good to see, because I basically, even talking to them in the past, it was, they were saying the same thing. No, it's first come, first serve, whatever, mm-hmm. And now they're like, I messaged them like, what do you have? And then they're like, oh, we have this and we're offering this, and, bring your buyers. I'm like, okay.
New movie starring realtors called The Shunning.
The Shunning. Yeah. Oh man.
Just horror stories about dealing with builders.
It's interesting too. I have some clients that are closing on new builds in September and October that signed purchase agreements, a year and a half ago, and the same builders are asking for an updated pre-approval letter, which I think is interesting. Maybe, and I don't know if that's because they've been having, and these are major builders in the city, and I don't know what the reasoning is. I mean, whether it's because of the rule changes or whether they've been having clients not close on properties. Or what the cause of it is, but have you been having any of these requests at all, Greg? Like updated letters?
I haven't. No, I haven't been involved in any new builds where that's been happening, and on any resales, it hasn't come up at all. That's very interesting, though, for sure. I mean, I guess it comes down to what we were saying earlier too. It's just protection. Yeah, for both parties. Mm-hmm. Definitely for both parties. It's not just like one side's all like, forget about it. It's like, no, man, like this is a good thing for you. Yeah. And that's, like I said, we got an offer on one and had a financing condition, and he was asking about it. He's like, what do you think? And I'm like, I would take it, man. I'm like, I would take it. He goes, but then it's not for, I'm like, no, but you know what? I go, if for whatever reason, this guy's, they're approved. They wouldn't be shopping if they're not approved. And but this will confirm that they're approved for your house at that price, and chances of it closing are, basically 100%.
We always,
but-
whenever I pre-approve clients too, and I know David, you do this as well. We always offer to provide them a pre-approval letter as well to include with their offer, because it just goes that extra way to say, like, even, and this is before even the chaos happened of the last 18 months. Like, I think even when you're putting in a financing condition, having that letter in there is just that extra little bit of credibility that it's more of a formality. Like, we're putting this in here to protect ourselves, but here's a letter from my broker saying that we've already been fully underwritten, pre-approved, etc. So it's really just that time frame of getting the firm approval from the lender, and it really is just that formality of that security for the buyer.
And we make sure that letter is also specific to that property. So whenever I'm providing a letter to the client, it's because them and the realtor have forwarded me that listing, and I vetted the numbers on that property for that client, what their max is. The max isn't in that letter, but it is specific to that property, stating we vetted, their income, their documents, all of that for, X address. And like Paul said, it definitely goes a long way, because it demonstrates that you've actually had, XYZ street vetted, as opposed to just a general, we've talked about before, just the general number on a napkin, pre-qualification that, the bank will spit out because you told them what you make.
And a personalized letter never hurts. When I was selling my place recently, I got a few letters of people talking about, loving the neighborhood and raising their family, and it helped a little.
Letters are good. I've been using them again with my guys. Yeah,
pulled on the heartstrings. Just.
Hey, but the eyes always go to the offer price. It's
for sure.
The letter gets thrown over the shoulder and right to the purchase price. Let's be honest here.
If there's two similar offers, one has a letter, one doesn't. The letter's winning most of the time. It's those little things they push you over the edge.
Agreed. Well, kind of over the edge, should we get to the mood boost?
Yes.
Yeah. Let's do it. Boost our moods, Paul.
So I have 5 today. I'm going hard.
Wow.
Hard in the paint. Wow. It is Canada themed. We're coming Canada Day week, and I wanted to keep it Canadian. So here we go. Number 1. Why are Canadian students so smart? They get a lot of A's.
Okay.
Number 2. How do you stop bacon? So curling, obviously a big sport in Canada. How do you stop bacon from curling in the frying pan? Take away its broom. I shouldn't have talked about curling as a sport before the punchline.
Yeah.
How do you get a Canadian to apologize? Step on their foot.
What?
Because we apologize for everything.
That's funny. Yeah.
I've actually, before I get to number 4 and 5, I've actually tried to make a point to say excuse me instead of sorry all the time. Yeah. Because it's like you bump into somebody, oh, sorry. Yeah. Excuse me is the proper term. Number 4, hopefully these are better. I'm swinging and missing here. Someone tried to sell me Canada, but I was having none of it. Wow.
Okay.
Just crickets. And number 5, pirate jokes always win. Why did the pirate move to Winnipeg?
Oh my God.
Wow, I fucked it up. Never mind. That's the end of the joke. Wow. The joke is, why did the pirate move to Manitoba? And he heard he could win a peg.
Oh man,
that would have been a great one to close on.
That's a good one.
Yeah, that would have been 1 for 5. That would have been 1 for 5. You struck out. You just went 0 for 5 on that one.
Oh, gosh. I need a vacation.
Yeah.
Well, thanks for tuning in, everyone. Right. Not embarrassed. We'll come back heavy next week. 5. I had 5.
Yeah,
you had 5
and
swings.
5 terrible ones. Actually, 4 good ones and one
good one.
One good one. Just you messed it up. Yeah,
I like 3. I like the number 3. I like 3 every week.
Yeah, 3's good. 3's good. I'll come.
Just the number 3.
3. As always, As always, thank you everyone for tuning in. Thank you for your support and your, I don't know why, but you keep coming back and listening to us week after week, and we just banter about real estate. So it's nice. We really enjoy doing this. So thanks for your support. As always, the show will be released. Well, if you're listening to it, it's been released Tuesday mornings, 10 o'clock on Facebook, basically anywhere, podcast platforms, YouTube, etc. And if you go to northbrew.ca and use the promo code podcast, you can get 20% off your coffee orders. Shout outs to James and the North Brew crew, and we'll get our t-shirts buzzing. And I'm going to look into that hat. I'm going to get a nice Tilly hat or something with the toe wrap.
Need some hats.
Yeah. Some Tilly for sure.
Tilly.
And all you buyers and sellers out there, just keep at it. Just keep working. Keep moving. If you got a dream, push forward. You can get there with the help of experts like us.
Like apparently.
Yeah.
Yeah.
Well, gentlemen, enjoy the Canada Day weekend.
Yeah.
Yes, you as
You
well.
too.
Well, this will be aired afterwards, but hopefully everyone listening had a great, safe Canada Day.
Past tense.
Yeah.
Past
We'll
tense.
see you. We'll see you in a few days. We'll see you Friday. See you
All right.
Friday. Okay. All right. Deuces, gentlemen.
Later, guys.
The Ottawa Real Estate Podcast is brought to you by Referral Mortgages, Blue Panda Realty, and Stephen Hopkins Video. Thanks for tuning in, and please remember to like, comment, share, and most importantly, subscribe. We'd love to hear from you.